Good afternoon, everyone. Today I would like to present a paper called Externality of Information, Lending to Peer Firms. This is a work-in-progress paper, so any comments are very welcomed. The big question about the paper is to study the role of information in lending. We know that information about borrowers is important for any investors. However, the information asymmetry exists in the lending contracts, as borrowers know themselves better than lenders. And also, information is very hard to collect, especially for those soft information, which is not easily or accurately reducible to numerical numbers. A unique feature of banks is their superior ability to extract this information through repeated interaction with borrowers, which can mitigate the information frictions. This can allow banks to reduce information and monitoring efforts when they lend to these firms again, therefore to lower the lending costs. Indeed, previous literature find that bank relationships can provide beneficial long terms. Meanwhile, banks not only obtain the information to judge more accurately about this firm, it also expands their information set to judge the growth potential of firm's industry as well as the conditions about the local economy. So this information helps them to evaluate similar firms coming from the same industry and area, which I called as local peers. So do banks also offer lower loan rates to these previous borrowers' local peers because they can reuse previous collected information? This paper tries to address the questions. It can help us better understand how information affects bank lending behavior. Do they reuse information? Does peer information matter for firms' credit costs? If the answers are yes, then it suggests information may have an impact on the capital allocation and then on the local financing conditions as well as economic growth. However, in contrast to relationship lending, whether banks will do so is ambiguous due to the trade-off between specification and diversification. On the one hand, lending to similar firms can reduce the information acquisition cost with a similar argument as relationship lending. However, on the other hand, having many similar firms in the portfolio can be risky, as these firms have higher default correlations. Diversification theory suggests that loan portfolio should be diversified in order to lower the bank risk. Moreover, the identification it is also hard to identify the mechanism is indeed due to previously collected information. Other factors can also result in lower loan rates. For example, banks may exhibit local bias, or they simply have better ability to collect information in certain areas with more bank branches. Also, the endogenous matching between banks and the borrowers would make the results harder to draw the conclusion. So this paper used the local peer fraud and misconduct behavior as an identification for the role of information, as these events should be exogenous to firms, but it indeed affects banks' previously collected information, making them feel harder to judge the credibility and become less confident to reuse. Hence, banks would behave more prudently and put more effort in screening and monitoring the current borrowers. This can increase the lending costs, making the previous beneficial loan terms offered to local peers disappear or diminished. So this paper is related to the following strands of literature. First, it adds to a vast literature about information asymmetries in lending. In addition to the previous lending, this paper shows that a relationship has certain externality in that the benefits can be shared with firms. Secondly, it's also related to the information quality on cost of credit. This paper shows that the cost of debt or equity would be more expensive or banks would write tighter contracts after the borrower's information deteriorates. I show that in this paper I add to the understanding of this literature by showing that not only firm-owned but their local peers' fraud behavior can have a negative effect on the cost of credit. Moreover, this paper studies the externality or spillover in lending. Although not explicitly studied, previous paper indeed shed certain light on this view. For example, Murphy found that banks would write tighter contracts after suffering other firms' payment default, even when the current firm is coming from completely different industry and geographical area. Garmice and Netvidad shows that neighbors can obtain more funding because of the increased supply of firm information. This evidence suggests that not only firm owns information plays a role, but also their local peers' information sometimes can have the impact on in bank lending decision. So the baseline empirical specification looks like this, which I regress the loan rates on the info variable, which proxy the information of bank to the firm, and a bunch of control variables x. I additionally add the delta BT, which is the bank year fixed effect, to capture any variables at bank year level. This can reduce the endogeneity in lending, which I would like to illustrate in a second. So standard errors are clustered at bank level. Let's consider this loan spread rate that depends on the bank and firm characteristics xb and yf, which we can only observe partially by x tilde and y tilde, such as size, credit rating. This z is bank b's information of firm f, which is proxied by info variable. So substituting these variables together, we would have this equation, because the banks and the firms are not randomly matched in that they choose each other based on certain characteristics. Especially for the banks, they would prefer firms with better credit availability, repayment ability. So this can make the covariance between this variable not equal to 0, which brings up the endogeneity issue if we cannot control all of them. So one way to solve the problem is simply to add bank times year fixed effect to wash out the mu b. Because the banks in my sample are typically large and engage in various business lending, this allows me to do so. So with that bank year fixed effect, the empirical strategy can be illustrated in this figure, where we consider a bank B lending to 3 firms, F1, F2, F3, which are all identical. So except whether bank B lent to their local peers or not. So first, let's consider the loan rates offered to F1 and F2. Bank B lent to F1's local peers, firm A, B in the previous years. So bank B it should have better, like an advantage, information advantage in evaluating firm 1. This would make the loan rates cheaper. So the first hypothesis is that the loans lending to firm 1 should be lower than F2. Then second, I would like to identify whether the information plays a role in the lower loan rates by comparing the loan rates offered to firm 3, whose local peers also borrowed from bank B once, but differently they committed fraud in last period. This would make bank B previously collected information unreliable, so bank B would refuse to reuse this kind of information to judge firm F3, but instead put more effort to evaluate firm 3 and monitor it. This would increase the lending cost. So by comparing the loan rates offered to F1 and F3, we can see whether information plays a role. Next, for the data. So the data comes from various sources. First, the loan data comes from DealScan, and I use the firm fraud or misconduct records from Securities Class Action Clearinghouse, in short SCAC, which covers all securities class actions filed in federal court after the Private Security Litigation Reform Act of 1995 came into effect. So these events typically are regarded as dishonest or fraud behavior conducted by the firms. In total, there are more than 4,000 securities filed in the SCAC. Other firm-level information is constructed using the datasets of CRSP CompuStat merged. Additionally, I use text-based network industry classification, or TNIC data, to measure the firm pair similarities. Bank branch level information is collected from Federal Deposit Insurance Corporation. So for each loan, I add borrower and the bank information, and then I restrict the loans based on certain criteria. First, exclude to financial companies, and then restrict to dollar-denominated loans syndicated in the U.S. and require borrowers and the lenders are located in the U.S. Note that basic observation in DealScan is a loan which is syndicated by a group of lenders with lead arrangers and several participants. I focus the analysis on lead arrangers because these are the one in charge of monitoring and issuing loans, while others are simply passive investors. And the data spans from 1996 to 2012. So I construct the following main variables. First, I identify whether a loan is a local peer loan by expanding the bank year loan portfolio. So I check whether for each loan, bank has already lent to the firm F's local peers in previous 3 years or not. The local peers is defined as firms in the same MSA and Family French 12 industries. Based on that, I construct two additional information proxies. First is called Info1, which is simply by counting the total number of loans Bank B lent to firm F's local peers, in which I refer to as Group S, in past 3 years. So the more frequent lending to certain Group S, the more information Bank B would accumulate. This also assumes that banks consider each firm coming from this group to be identical, or let's say banks have equal priors for each firm coming from this group. Secondly, I construct Info 2 at the firm level by taking the firm similarities into consideration. It should be reasonable if the current firm is more similar as the ones bank once lent to. Therefore, they have more relevant information in judging the firm's behavior. This can be constructed by the score which comes from this TNIC dataset. So I aggregate all the local peers with the firms using this firm pairwise similarity measure, which is based on the similarities of the product description in the 10K filings. And then I transform them into loan level using the average values for loans with multiple lead banks. Next, I construct two fraud variables based on whether firms filed in SCAC or whether their local peers filed in this SCAC. Note that this peer fraud variable is at loan level because I require this local peer of firm F is in bank's current loan portfolio. So next, I also control for a bunch of control variables. First, the relationship loans is to identify whether a bank has already lent to this firm in previous 3 years. And the deposit ratio, which captures the physical existence of bank in each MSA by calculating the ratio of bank branch deposit. And concentration risk captures the exposure banks to certain group of firms in the loan portfolio. And other firm and the loan controls are standard in the literature. So in summary statistics, the final sample contains 19,263 facilities because there are loans with multiple lead arrangers, which spans the dataset to 24,674 firm bank loan observation from 1996 to 2012. The median loan in the sample is $150 million with a 4-year maturity and 175 basic points credit spread. There are around 4,000 firms in the sample, and about 16% of them ever filed in SCAC during this time. Most of them only filed once. Now I present the empirical results, where I divided into 2 parts. First, I would like to present evidence that lending to borrowers' local peers can indeed result in lower loan rates. By regressing this regression, where 8 is the credit spread, which is the most comprehensive measure of cost of borrowing on the local peer and other control variables. So in the first column, I only add year fixed effect to wash out the national variation in credit spreads. And also, a typical firm borrows several times in the syndicated loan markets. So this allows me to add borrower fixed effect to wash out any time invariant firm features like industry and locations. Next, I add bank fixed effect to look the results within a bank, and also bank year fixed effect. The results are also consistent and robust. In the fourth column, I additionally add the MSA year fixed effect to wash out the local level variables such as credit demand or any in growth rate and unemployment. So that all the results are robust. Remember, note that the data is at bank loan level because of these loans with multiple lead arrangers. So I expanded, and so this should not be a problem because with the bank fixed effect, it should be not a problem. But I again perform a robustness check by making the data unique at loan level and randomly keep only one lead arranger. The results are also robust. Another concern is for the numerous existence of the relationship loan in the data sets, which I controlled in the previous specification. I also try to drop these relationship loans, so the remaining loans only contains of the loans for the firms. These firms, it's the first time for them to borrow from the banks. And all the results hold. So on average, a local peer loan would obtain 10 basic point lower loan rates, which if we transform to the average size of the loan amount would be $150,000 lower. And the results are robust at loan level, also dropped relationship. Secondly, I add information proxies in the equations, and we can still find the negative sign, meaning when banks lend more frequent to this area group of firms, they would obtain cheaper loan rates, and it is even cheaper when the firms. It is also cheaper when the firms is more similar as banks once lend to. In column 3 and 4, I additionally add this local peer, so the coefficient stands for even, so conditional on this loan is the local peer loans, it will still get more beneficial loan terms. On average, one standard deviation increase in this info 1 is associated with 6 basis point drop in credit spreads. The results are robust at loan level and also by dropping regression relationship loans. I additionally done a robustness check using the instrumental variable result specification, where I choose to use the nearest distance between a firm and any branch of its bank. This IV should satisfy the following two conditions. First, the exogeneity. It should be exogenous to the loan rates, as the distance should be these firm and banks should be existed prior for the negotiation of the loans. Second, it should be relevant with bank information because they should have better ability to collect reliable information with branches nearby. Also, this variable, this IV should in the literature, people normally choose to use the distance between headquarters of banks and firms, but some regards the distance as a price factor. Using the distance between a firm and any branch of bank would avoid this discussion because firms do not borrow syndicated loans from bank branches. So the results are presented in the table, where the second stage are significantly negative and showing a lower loan rates for this group of firms. And the first stage shows that a closer distance would indicate more information. Next, I try to identify the role of information by examining the cost of credit when the information deteriorates. Fraud or misconduct behavior should deteriorate bank information towards the group of firms. Therefore, these previous beneficial loan terms offered to the local peers due to information should be diminished. So first, to begin with, I explore the time pattern of credit spreads before and after the fraud behavior of firms or their local peers to confirm that this fraud behavior can raise the cost of credit. So the results are shown in this table. Well, we can see T is the time when firms committed fraud in the first column, and we find that the cost of credit increased dramatically in the following 2 quarters. This is also the case if we consider the time when their peer committed fraud with all the previous specifications. So this is also illustrated by this figure, where we can see more intuitive, more directly that the loan rates raises after the time when the firm or their local peers committed fraud. This is even after we control for any regional spikes of misconduct. So next, I use it as an identification to interact with the local peer loans. The coefficient of this interaction term beta 2 indicates whether this subgroup of loans whose local peers committed fraud in last period would result in a more expensive loans comparing to other local peer loans. And indeed, the results shows that the sign is significantly positive, and also the sum of the beta 1 and the beta 2, so the linear combination of these two coefficients is insignificant and small, meaning that the previous beneficial loan terms for local peer groups disappear. This results is consistent with the hypothesis. One may concern that banks may raise loan rates to all borrowers after information deterioration, just as Murphy 2012 paper finds. However, this bank-specific variable should be washed out by bank year fixed effect. So that's the main results of the paper. Previously, I find that information deterioration can negatively affect the cost of credit. Next, I would like to explore whether it can affect the loan quantities. To implement that, I aggregate all the loan amount banks lend to this group S in each year, so I can calculate the delta of the aggregate loans and to identify and to define a variable to be 1 if it's smaller than 0, meaning that bank decrease lending to this group of firms in time t, and then regress it on whether peer fraud in last period to test whether banks would change the loan quantity, like change the lending activities to this group of firms after peer firms committed fraud. So their information deteriorates. I find a significant positive sign for this coefficient. This suggests that banks would be aware of the misconduct behavior of these firms and then change the lending strategies accordingly by reducing lending business to this group of firms. These results are also consistent robust when I control for the credit demand at local or industry level. So banks would reduce lending to the group of firms after their local peers had financial misconduct, suggesting the financial misconduct can pose negative externality on local firms in terms of credit availability. In conclusion, this paper presents the evidence that banks would offer lower loan rates if they lend to similar firms before, indicating local peers matters for firms' cost of credit. This is because banks can reuse the previously collected information to judge the current firms, which mitigates the information mitigate the information frictions. Moreover, I also find that local peers' misconduct can pose negative externality on credit costs as well as loan availability, showing a bias of banks in reusing information. So all in all, this paper finds that information has externalities in bank lending decisions. Thank you very much.